Let me get this thing on the road here. Before we kick off our event today, I do want to cover some housekeeping items. For our guests on the side, you have a few different options in there. You have a chat section. So anytime throughout the webinar today, you can go in there and make any comments, or if you have any questions, there's a spot in there for you to write your questions down. We do have a special Q&A at the end. We got about 10, maybe 15 minutes, depending on how that goes, for our guests to answer any and maybe all of those questions. There are also some additional resources on Abiding Wealth and our webinar in our handouts section. So you can definitely go in there at any point and download that information at any point. So without further ado, I'm going to introduce our very remarkable guest today. Candice is Managing Director in the Global Client Business within Goldman Sachs Asset Management, and serves as Global Head of the Strategic Advisory Solutions team. She focuses on global capital market research, macroeconomic strategy, portfolio construction, and client engagement. She is a founding board member of the Rutgers Business School Center for Women in Business, and is a board member of the Rutgers Business School Dean's Board of Advisors. She is also an associate board member of the Junior Achievement of New York. And so we have an awesome picture. So, you know, we can't see her, but this is Candice Tse. So please help me welcome her, and I'm going to kick this over to you, Candice.
Great. Bryce, can you hear me?
Yes.
Okay, great. Well, let me first apologize by saying my video is not working for some reason, so I'd rather see all of your beautiful faces, but I do see Bryce's. You just can't see mine. So I'm happy to be here with you today. As Bryce mentioned, I had a group here at Goldman Sachs called Strategic Advisory Solutions, and basically we publish quite frequently, weekly, monthly, quarterly, on everything macro and market related, and help clients with their portfolios. So with that said, one of the things that I want to highlight is our outlook going forward. And we tend to write with themes. So the themes moving into towards year end is called micro scope. So let me walk you through what exactly that means and why it's so timely for our discussion today. So if you do have a copy of my presentation, if not, I'll walk you through some high level thoughts of what I want to cover today, and then we'll open up to questions. A key question these days has been, what is the Fed going to do? What's next? And from our perspective, we think that the Fed has likely ended one of their most aggressive tightening campaigns in many, many generations. So going forward, we expect that they'll probably continue to pause through the rest of the year and then start subsequently cutting every quarter. By the end of fourth quarter 2024 is when they'll start. So again, we think the Fed is most likely going to pause all the way through till the fourth quarter of 2024 and then start cutting rates by a clip of 25 basis points. And we think they continue to cut rates to the point where they bring the neutral Fed funds rate to about 3% to 3.25%. So we do think that they're going to hold steady for a while, but there's a lot of data points that Jerome Powell and the rest of the Fed are looking for. They're looking at, you know, inflation, where that goes from here. They're looking at the labor market rebalancing. They're looking at, you know, how policy is funneling its way through the economy, and that will likely impact their rate cut timeline. So our view is still one where we think we can achieve a soft landing, meaning we don't think a recession is imminent. And the reason why we think there's a potential for a soft landing is we believe the Fed has engineered a way to soft land this economy. Now, the reasons are, one, the private sector balance is still very strong. Number two, there's still real income growth in this economy, and there's still consumer resilient. Number three, we've seen labor market strength. And number four, we've continued to see most folks believe that long run inflation expectations are still that inflation comes down lower over time. So those are the four main reasons why we think a soft landing can still occur in our US based economy. Now, don't get me wrong, there are many different risks that we are monitoring, and the macro risk that we're monitoring is one, as I mentioned before, inflation. If there is difficulty in keeping inflation down, that's a macro risk. Number two, that would trigger the Fed to hike rates instead of pausing and cutting rates. And then number three, the yield curve inversion that we see, meaning, for example, the difference between the 2-year yield and the 10-year yield, if that continues to steepen, then that could cause some macro conditions. And then, of course, if we see a deterioration of the buffers from the consumer side, those are basically 4 main reasons why the macro picture could take a tilt to the downside. But again, not our base case, but those are risks that we're monitoring. So the bottom line with these views is the fact that we think that right now, central banks around the world are diverging in terms of what they're doing. And as they diverge with cutting rates, hiking rates, holding rates, it's actually creating a great diverse opportunity for investors across asset classes. So shorter term, in terms of the US equity market, we do think the equity market is constrained at this point. So at the end of the year, if things continue to go along this path, we think the S&P 500 could land around this flattish area of 4,500. If we look at the broader scale picture of investments, we think there's opportunities in global equities outside the US and also for broader fixed income alongside with alternatives. So that's just a very high level view of what I wanted to cover. But what I wanted to also cover is the fact that if you're in the camp that we are in recession or feel like we're going into recession, first I want to acknowledge you're right? And the reason why I say that is because the economy is giving us mixed signals. So if you think about the type of economy that we have today, there are 2 types of economic data points that come out every week, every month, every quarter. There's soft data and there's hard data. Soft data is the sentiment-driven data. Those are the surveys that go out asking the consumer, what are your expectations for the economy? They're the surveys that go out and ask small business owners, what's your level of business optimism, right? So from a softer side, perspective, the sentiment is quite negative, right? Because we go and fill our gas tanks in the car and it's very expensive. We go into the supermarket, and I'll never forget the first day I walked into the supermarket months ago, and a dozen of eggs cost me $7 and they weren't organic. So every single day we feel it in our pockets. So from a softer side, the sentiment is more negative, and that tilts investors to either believe we're in a recession or headed to one. However, if you take a look at the hard data are the actual numbers, right? The numbers that are published, the numbers of cars being sold, right? If they say there's 200,000 cars sold, then that means there's 200,000 less cars in the dealerships and 200,000 cars on the road. If they say they're building new homes, right? The millions of homes they're building means that there's more, housing supply out in the economy, right? So those are hard numbers. And when you take a look at the hard data, it actually paints a rather different picture from how you feel. The hard data actually shows you more of reality, which is the economy is stronger than it feels. So we do think that the perception, the way you're feeling, is very different from what's happening in economic reality. And for that reason, yes, if you feel like we're in a recession or going into one, I completely empathize with you because we feel it in our pockets. But if you take a look at the broader economy, actually the signal that's being sent from the economy is that reality is actually stronger than it might feel, leading us to our belief that a soft landing is still possible. Now, don't get me wrong, there are many different levers of volatility that could move your portfolios and your investments at any given time. And there are really some key sources of volatility. One is the Fed. So anytime we have the Fed meetings, the market is trying to read into every single word that Jerome Powell was saying. So anytime we have those meetings, monetary policy, whether they pause, hike, or cut, can cause volatility in your portfolio. In terms of inflation, every time we get an inflation print, if it is higher than expected, if the numbers are not what we thought it would be, that could move markets, right? We think by year end, core PCE, which is the inflation measure the Fed looks at, should come down to 3.4%. So we still believe that inflation at this point today is coming down to a level that is healthy, right? It's going to take some time to get back to that 2+% range, but nonetheless, we think we can get to the 3.4% by end of the year. In terms of market concentration, what we've seen drive markets over the course of the last number of months is just a handful of stocks that have outperformed. So if you take a look at the combined weight of the top 5 stocks by market cap, they represent 25% of the entire investable universe of US equity. So there's a huge market concentration, particularly with technology related stocks that have been outperforming. So that market concentration moves your portfolio, because if those 5 stocks do well, the market goes up. If those 5 stocks have a bad day, it tends to move the other direction. So that creates volatility. And last but not least, how expensive is the market? Because if we look in hindsight, it's very expensive compared to history. We are trading at the 82nd percentile of expensiveness over history. So at this point, when markets are so expensive, it, particularly in equities, is a source of volatility. Now, I don't want to leave you with just areas of volatility. There's also some counterbalancing areas within the market, areas of stability. And that is one, the consumer. Because even today, we still think that there is a buffer provided to the consumer. And if you take a look at different metrics, for example, delinquency rate of all consumer loans, right now it's at 2.4%. And versus the long-term average, which is 3.1%, the consumer is still in good standing, right? And as I mentioned before, there's still real income growth at this point, and there's still consumer resilience. So that is a source of stability. Secondly, if you look at the labor market, there's still a major job workers gap. So the amount of jobs out there is still higher than the amount of workers available to work those jobs. So right now we have a cushion of 2.5 million more jobs than workers, and that provides a potential buffer, and that's a buffer from massive layoffs, right? Meaning there's many more jobs still out there. So I don't think there's going to be massive layoffs across sectors, because we're still looking for people to work. So that's providing a cushion from a labor perspective. Thirdly, I'd say if you take a look at corporations around the US, there's actually only 4.4% of US companies, particularly high yield debt companies, meaning more of the more riskier companies here in the US, that have debt set to mature this year and next year, only 4.4%. Now that means the other, let's say 96% of the companies within the US are in good standing, meaning they've locked into ultra low interest rates for many years to come. So that from a corporate side is a source of stability. And last but not least, the housing market. I know it sounds counterintuitive, but if you think about it, the housing market actually showcases that many of us benefited from refinancing during COVID. And 98.8% of the outstanding 30-year conventional mortgages have locked in rates below 7%. So many of us, 98.8% of us, have locked in low rates for many years to come, which is much lower than the going rate right now if you took out a mortgage on a new house at this point. So those are 4 key sources of stability. But I'm also happy to throw out another one, right? I talked about inflation expectations. So at this point, if you take a look at the broader market, the expectation, as I mentioned before, is that inflation can still come back down to the lower single-digit levels from the highs they've been at. Now, if you think back to the 70s and 80s, it wasn't the case, right? For the broader public, people perceived inflation to stay at levels of 6, 7, 8, 9, 10%. So at this point, the market still believes that inflation can come back down. And it's very important, because inflation expectations and where investors believe inflation is going drives their behavior. And many of us still believe that inflation can come down to lower levels. So that's a good thing. The Fed wants to anchor inflation expectations, and they want the market to believe and feel and consume in a way that they know that inflation will still keep coming down lower. So what that means to the global economy is the fact that globally, GDP growth will remain at trend. So for the US, for example, we still believe we're going to go above trend this year at 2.2%. Typically, in any given year, the US grows at about 1.8%. So 2.2% is higher. So we're still growing at higher levels than normal average, but we sure has come down from the highs that we've seen during the recovery of COVID early on. Same thing with the Euro area. We think they'll be growing around 0.6% this year. We think the UK will grow at about 0.5%. So over the course of the next 1 to 2+ years, we still see at trend growth globally. And we're going to see some countries that have greatly reaccelerated growth because of their later recovery to COVID start to decelerate their growth from higher levels to a more sustained at trend growth level. Now, the way this impacts your investments in your portfolios is that the current macro conditions, as I mentioned before, showcase and demonstrate a broader opportunity for investors to invest across asset classes. What I mean by that is, again, within equities, we know that long-term equities will still be resilient for your portfolios, but near-term, there's going to be a lot of volatility. So we do think that as we consider the longer-term performance of equities, we do think it's more muted than before, because the last 10 years, if it delivered, close to 14% annualized returns year over year, going forward is probably going to be more mid-single digit level. So still resilient long-term, but near-term, there will be a lot of volatility. In terms of rates, we think it will level off, and that's going to be reflective of what the central banks are doing around the world, including the Fed. And then in terms of currencies, we've seen the US dollar be very strong, right? It's a safe haven investment. Anytime investors are concerned about anything, headline news, concerns about government shutdown, concerns about US-China tensions, anything, the US dollar tends to strengthen. So we do believe that there will be pockets of short-term US dollar strength because of global uncertainty, but we do think that long-term, the US dollar will weaken, and it will weaken versus other currencies like the euro and other Asian currencies as those economies continue to recover and strengthen versus the US. So short-term US dollar strength, long-term US dollar weakness. And last but not least, I'll cover commodities, right? From a commodities perspective, we do think that commodities as a broad complex will continue to move higher. So if you're thinking about oil, you have OPEC plus nations continuing to decline production. We continue to see demand is high. So there is a supply-demand imbalance. And we do think that oil can move higher over the course of the next, couple of months to year. And that's not just oil, but we also see that, other areas of commodities like copper, aluminum, base metals, they all have the ability to move higher as well. So from a capital market forecast perspective, resilient equity long-term growth, we think volatility in the near term. From a fixed income side, bond side, global rates leveling off based on what central banks are doing. From a currency perspective, short-term US strength, long-term US dollar weakness. And then from a commodity perspective, the ability for most commodities to continue moving higher because of the supply-demand imbalance. So let me just talk about one more topic and then open it up to questions because we're at the 20-minute mark. What do you do as an investor in this next cycle? We think the last cycle was very different. The last cycle, we had strong growth, falling interest rates, rising profit margins, limited market volatility. So that led to a time called TINA, T-I-N-A. In the last 10 years, there is no alternative to equities, right? Equities was the best performer, especially US equities, tech companies versus other sectors, US equities versus international, growth equity versus value. That's what worked in this last cycle, the last 10 years. Moving forward, in this cycle we're in, less growth, rising interest rates, stable profit margins, more episodic volatility. TINA, T-I-N-A, turns to TARA, T-A-R-A, meaning there are reasonable alternatives to equities now. And those alternatives reside in global equities. Those opportunities reside in areas of fixed income, bonds, and those areas reside in alternatives. So with that, I'm going to take a pause and turn it back to Bryce to see if there's any questions on anything I talked about or any questions I haven't talked about.
Awesome. No, I think you've obviously done a phenomenal job. I do have a question. Let me get through here and pull it up for you. Are you able to see that, Candice?
Yes. It looks like the question is, from your perspective, is it a time to rebalance towards stocks or bonds? I think that's a great question. So I'm of the mindset that at this point, looking at your bond portfolio, if you haven't started investing in bonds, obviously it's probably been a little tilted towards equity because of the equity performance. So as an investor, yes, it's a great time to consider bonds at this point. If you're a tax sensitive investor, things like municipal bonds can help from a tax perspective and a yield perspective. If you're a bond investor, hopefully you would have invested, looking at the shorter end of the curve, 2 years, the yields have been very, very attractive. I would say, maybe it's not time to pull all your money out sitting in short duration, but you can extend the duration and you can extend duration further out into the curve, into other areas of fixed income. Core fixed income is very important for your portfolio, because should we be wrong and we fall into a recession, again, recession is not our base case, but should we be wrong, that fixed income portion, that bond portion of your portfolio should be able to keep your portfolio afloat. Now, the other opportunity set within this is the income that bond generates, right? So you don't have to wait till the end of the year to see what equity markets do. You can actually generate a lot of that yield within the fixed income portion, which is why this is a great time to consider this particular asset class, whereas the last 10 years, it might not have been so attractive. But again, because of what central banks are doing with raising rates, it's really opened up the opportunity, especially within the fixed income bond area.
Okay, awesome. I am checking now, Candice. I actually do not see any other questions outside of that. So I know you packed a lot in that 20-25 minutes, and we do appreciate you making time to host with us today. I don't see anything else coming in. So for our guest, again, you've got some handouts and some resources over there that you can download. If you had to leave or you just joined us, this has been recorded, and we'll get to share this out a little bit later on. Candice, thank you for your impact, not just at Goldman Sachs, but at Rutgers and with the women in business and what you're doing. We appreciate your heart for that. And so again, thank you for your time today. I think with that, we're done.
Great. Thank you so much, Bryce. And I hope to see all of you on screen or in person in the near future. So thank you for the opportunity to speak with you today.
All right. Thank you. Have a good day.